Understanding decentralized finance, the core concepts. Decentralized finance, often called DeFi, is a new way to handle money. It uses blockchain technology and cryptocurrencies to offer financial services. These services include things like lending, borrowing, and trading digital assets. A key feature of DeFi is that it works without traditional middlemen. This means there are no banks or brokerage firms controlling the transactions. Instead, DeFi platforms operate on open, permissionless networks. This approach aims to create a more transparent and accessible financial system for everyone involved, changing how we interact with financial products. The core principles of DeFi revolve around giving users more control over their assets. In traditional finance, you often entrust your money to a bank. In DeFi, you can hold your assets directly using your own digital wallets. Interactions are peer-to-peer, meaning users transact directly with each other or with smart contracts. Smart contracts are self-executing pieces of code that automate financial agreements. They run on the blockchain and enforce the rules of a transaction without needing a central authority. This automation increases efficiency and reduces the potential for censorship or single points of failure in financial operations. Blockchain technology is the foundation upon which DeFi is built. A blockchain is a distributed ledger that records transactions in a secure and transparent manner. Once a transaction is added to the blockchain, it cannot be easily altered or deleted, making the system tamper-resistant. This immutability builds trust among participants without requiring them to know or trust each other directly. Every participant in the network can, in principle, view the transaction history, which enhances transparency. This shared, verifiable record is crucial for DeFi applications to function reliably and openly for all users. Cryptocurrencies are the native assets used within DeFi ecosystems. They serve as the medium of exchange, store of value, and unit of account for various DeFi protocols. For example, you might lend out your cryptocurrency to earn interest or use it as collateral to borrow other digital assets. Stablecoins, which are cryptocurrencies pegged to stable assets like the US dollar, play a vital role in reducing volatility. Governance tokens give holders a say in how a DeFi protocol is run. These digital currencies are essential for facilitating the complex financial interactions that occur within the DeFi space, enabling new forms of value transfer. DeFi versus traditional systems, a new financial landscape. When we compare decentralized finance with traditional finance, or TradFi, the most striking difference is decentralization. Traditional finance relies heavily on centralized institutions. Banks, stock exchanges, and clearinghouses act as intermediaries, controlling the flow of money and access to services. These institutions also act as points of trust. DeFi, however, operates on distributed networks. There is no single entity in control. This structure aims to reduce systemic risk because there isn't one central point that can fail and bring down the entire system. It also means that decisions about the network are often made by a community, not a board of directors. The removal of intermediaries is another significant aspect of DeFi. In traditional finance, intermediaries take a cut for their services, leading to fees for transactions, lending, and investing. DeFi aims to reduce these costs by allowing peer-to-peer interactions facilitated by smart contracts. This can make financial services cheaper and more efficient. Transactions can often be processed faster than in the traditional system, which might involve several intermediaries and manual processes. This disintermediation is a core value proposition of DeFi, promising a more streamlined financial experience for users around the globe. It is also useful to compare DeFi with centralized finance, or CeFi, within the cryptocurrency world. CeFi platforms offer crypto-related services such as exchanges or lending, but they are run by centralized companies. These companies control user funds and data, much like traditional banks. While CeFi can be more user-friendly for beginners, it reintroduces some of the risks of centralization, such as company insolvency or censorship. DeFi, in contrast, strives to be non-custodial. This means users maintain control over their private keys and therefore their assets. This self-custody is a fundamental principle for many DeFi advocates. Accessibility is a key area where DeFi seeks to improve upon both TradFi and CeFi. Traditional financial systems often have high barriers to entry. These can include geographical restrictions, extensive Know Your Customer, KYC requirements, and minimum capital amounts. While CeFi platforms are often more accessible than TradFi, they too can impose limitations. DeFi protocols, in theory, are open to anyone with an internet connection and a compatible crypto wallet. This accessibility has the potential to bring financial services to unbanked or underbanked populations worldwide, fostering greater financial inclusion and opportunity for many people. Navigating the challenges policy and regulation in DeFi, decentralized finance presents unique challenges for existing regulatory frameworks. Traditional financial regulations are typically designed for centralized entities where there are clear legal persons or corporations to hold accountable. The decentralized nature of many DeFi protocols makes it difficult to identify who is responsible when things go wrong. This can weaken the effectiveness of current laws regarding consumer protection, anti-money laundering (AML), and combating the financing of terrorism (CFT). Regulators are grappling with how to apply rules meant for intermediaries to systems that aim to operate without them, creating a complex legal puzzle. Beyond regulatory uncertainty, DeFi also comes with its own set of inherent risks. Smart contracts, the backbone of DeFi applications, can have bugs or vulnerabilities that malicious actors can exploit, leading to significant financial losses for users. The complexity of some DeFi products can also be a challenge, making it hard for users to fully understand the risks involved, such as impermanent loss in liquidity pools or the mechanics of algorithmic stablecoins. Unlike traditional banking, there is often no deposit insurance or central authority to turn to for recourse if funds are lost due to hacks or protocol failures. Policy considerations for DeFi are therefore complex and multifaceted. Governments and regulatory bodies worldwide are trying to strike a balance. They want to protect consumers and maintain financial stability without stifling the innovation that DeFi promises. A major point of discussion is how to classify different DeFi assets and activities under existing securities, commodities, or banking laws. There is no global consensus yet, leading to a fragmented regulatory landscape where different jurisdictions are adopting varied approaches from cautious observation to proactive rulemaking. This uncertainty can be a barrier to broader adoption by institutional players. Several regulatory strategies are being explored to manage the risks associated with DeFi. One approach is to focus on regulating the centralized on-ramps and off-ramps. These are the points where traditional fiat currency is converted into cryptocurrency or vice versa, such as centralized exchanges or certain wallet providers. By applying AML and KYC rules at these gateways, regulators can gain some oversight. Another emerging idea is embedded regulation, where compliance could potentially be built into the DeFi protocols themselves through smart contracts. Though this is technically challenging, the goal is to find ways to supervise activities rather than just entities. The future unfolds DeFi's potential and open banking synergies. Looking ahead, the future potential of decentralized finance appears vast and transformative. DeFi could fundamentally democratize access to a wide array of financial services on a global scale. Imagine individuals in developing countries easily accessing loans, investment opportunities, or insurance products that were previously out of reach. Complex financial instruments, once the domain of sophisticated investors, could become more transparent and available to a broader audience. This increased access, combined with the inherent transparency of blockchain technology, promises to create a more equitable and efficient financial ecosystem for all participants. There is a strong connection between DeFi and the broader trend of open banking. Open banking initiatives encourage traditional financial institutions to share customer data, with consent, with third-party developers through application programming interfaces, APIs. This fosters competition and innovation by allowing new services to be built on top of existing banking infrastructure. DeFi can be seen as an extension of this movement, taking it a step further by building an entirely open and programmable financial system from the ground up. Both movements share the goal of empowering users with more control over their financial lives and fostering a more competitive marketplace. The pace of innovation within the DeFi space continues to be remarkably rapid. New protocols, applications, and financial primitives are being developed and deployed constantly. We are seeing experimentation in areas like decentralized identity solutions, which could enhance security and compliance, as well as novel approaches to decentralized insurance, derivatives, and prediction markets. This relentless cycle of building, testing, and iterating is crucial for the maturation of the DeFi ecosystem. While not every experiment will succeed, the collective learning drives the industry forward, helping to identify sustainable models and robust solutions for real-world financial problems. In conclusion, while DeFi certainly faces challenges related to security, usability, and regulation, its potential to revolutionize finance is undeniable. It represents a paradigm shift towards a more open, transparent, and accessible global financial system. The drive for innovation in this space is fueled by a desire to empower individuals and create more efficient markets. The opportunities for new financial products, services, and even entirely new forms of economic organization are immense. The journey of DeFi is still in its early stages, but it holds the promise of reshaping our financial world for the better in the years to come.